Okay.
And so
Gotcha.
we work with people all over the nation, but mostly Texas-based. There's a lot of real estate transactions and commercial real estate going on in Texas right now. It's super hot. A lot of people are coming from California and elsewhere. So we see most of our exchanges in Texas. It's interesting because a lot of our kind of local investors have switched over and they're now exiting in Texas and looking elsewhere. So
that's how it goes.
A lot of movement.
Yeah. All right. Well, it's 7 o'clock.
And real quick, Cori, are you an investor as well then? Do you have properties?
I am not. No, I'm a recovering attorney. So
we won't hold that against you.
The joke in law school is that there's 3 reasons why you become an attorney. Number 1 is because usually you're bad at math, and number 2 is usually because you're really terrible at math.
I like it.
All right.
So which category are you again?
It's 7 o'clock. So let me introduce Cori, and then we will move on into questions and what we all gathered to talk about. But
do you, Anthony, do you have a video tonight, or is your capture card not working?
Man, I don't even want to talk about it right now.
We'll discuss later.
It is traumatic. I'm going with just the nameplate this time. So
it works.
So everybody, welcome to the weekly Multifamily Roundtable. This week's guest is Corrine Iadonisi. She is a former corporate attorney and serves as managing director, structuring 1031 exchange transactions. She gained industry experience working for a subsidiary of First American and oversees hundreds of millions of clients' funds. She has a unique approach to ensuring an unparalleled level of client service in every exchange, including forward exchanges, reverse exchanges, and construction exchanges. Prior to her work at GPX, Cori served as a legal fellow to Congresswoman McMorris Rodgers, handling regulatory issues and drafting national policy. Her experience on Capitol Hill taught her that the intricacies of the subtle but important differences between statutes and agency rulemaking and guidance. She applies this experience today in communicating 1031 rules versus gray area to clients and keeps references on hand to help their clients' counsel structure unique exchanges. Cori also believes that the best clients are the ones that are well-informed and invests her time writing and teaching 1031 curriculum throughout the U.S. How was that?
That's fantastic. Thank you so much. This is beautiful.
Absolutely. Thanks for coming on, Cori.
Absolutely. Well, thank you guys so much for having me. I'm really excited to have this conversation with you and, to field questions. As I was telling Rodney, the best, I think, education that you can get in 1031 exchanges is asking a lot of questions about things. It can be a very dry subject. Usually it's tax attorneys that are talking about 1031 exchanges. So I always make a joke with my clients that if they want really good reading material to put them to sleep at night, they should look up exactly what we do in the IRS code.
So yeah, and real quick for the two attendees that we have here so far, Dan and Eric, if you guys have questions, feel free to throw them in the chat, throw them in the Q&A section there. We'll get to them as we go through here today, and we're gonna hopefully extract as much information out of Cori as possible.
And, I was gonna mention too the difference between the chat area and the Q&A area is the Q&A area gets recorded. So if anybody watches the recording later, they're going to see those questions that are posted in the Q&A area versus the chat area does not get recorded. So that's the difference between the two. Hey, Cori, one of the things that we were curious about is Are 1031s primarily used by active investors or passive investors or both?
That's a great question. So let me back up just one step and give a little bit explanation about why people use 1031 exchanges. There's essentially two reasons why you would want to use a 1031 exchange. And just for those of you, if you're not familiar with 1031 exchanges, a 1031 exchange is when you're selling a piece of real estate and you're going to realize capital gains on that sale, but you want to reinvest those proceeds into a new investment property. The IRS has said, well, if you're going to essentially just trade one property for a new property, we're going to allow you to keep all of that money in the market and not have to write a check to the IRS for your capital gains bill, as long as you do it in accordance with our rules. And so that's where the statute comes in. Congress, came in and they said, we're going to put certain limits on this so that the system does not get abused. We don't want people running around just evading taxes forever. That's a bad thing. And so we're going to put some structure around this. And one of the things that they say is that there's a couple of different ways to do 1031 exchanges properly, but you have to have some sort of third party that is not an agent of the taxpayer or the exchanger that's doing these. And so that's where a qualified intermediary comes in. So when you're doing one of these exchanges, if you think about it, you have to bring somebody in order to help you with this transaction, but it's intended to be a trade for one piece of property that you have into a new piece of property that you're buying into. And so it should be a deed for deed kind of swap is what it looks like on paper. And so we do a lot of legal stuff behind the scenes to make sure that the exchange is set up properly on paper. But then at the end of the day, you don't have to write a check to the IRS for your capital gains taxes. So the two strategies that people use are, number one, if you're trying to just roll over your money into a new investment that's going to be in real estate anyhow, if you're in this industry, a lot of times the amount of capital gains that you might have to pay on something that you're selling is enough to put a down payment on the next property that you're going to buy. If you're dealing with 10 or 20% down payment. And so people say, well, shoot, if I don't have to write a check to the IRS right now, if I can defer that and pay it later, then I can use that money really to leverage a better investment the next time that I purchase. And so if that's your strategy, you can use the 1031 exchange almost like you would an interest-free loan from the IRS. Think of it that way in terms of you're going to have to pay the money back at a later date, but you don't have to pay back your loan until you cash out of your property and you finally sell and put that money in your bank account. So that's the first strategy that people use. The second strategy that people use is if they have a bunch of investment properties and they know that their family is going to inherit their portfolio or some of their portfolio. The cool thing about 1031 exchanges is when you pass away and your heirs inherit your property, the bill that you would have sent to the IRS all of a sudden gets completely forgiven. So there's a step up in basis, is what they call it, that happens. So when you pass away, your heirs inherit the property at the fair market value on that day. And at that time, they get a step up in basis in that property so that the taxes that you would have paid during your lifetime are never due. So those are the two strategies that people use. So, you know, it really depends on how you're using the investments as you go along in your lifetime. It can be a great way to build wealth for your family. It can be part of like a personal planning strategy where you have assets that you can pass on. That's different than just, you know, leaving a bank account or leaving an insurance policy for them. So depending on where their strategy is, you might have somebody who likes to own properties, manage properties, and be very invested in the business. And so we see a lot of 1031 exchangers that own apartment buildings, that own hotel buildings. Those are great, industries to do 1031 exchanges in. And then you have people who invest in real estate and they just want to be passive investors. They just want to park their money somewhere in order to diversify their assets. And so somebody really has to ask themselves, are they going to continue to invest in real estate? And if so, then I think 1031 exchanges are a great thing to look at and talk about with your advisors in that sense. So it can be used a couple of different ways. And I think that, Rodney, we had talked a little bit about when you have limited partners or, if you need to own the property outright. And so is that what your original question was sort of pointing at?
I think you're muted, Rodney.
You're on mute.
Thank you very much. Anthony, do you want to state the question? Because it was kind of a curious point on your part. I kind of had the perspective that that all could benefit from it, and you brought a unique perspective that I think that might be worthy to be brought up here, so that we kind of have the
Sure.
right view here.
Yeah. So, Cori, that was a great summation. I think that for people that aren't familiar with the 1031 exchange, that's going to be like a huge first step in their education, is just kind of understanding what it's being used for. For us specifically, so we syndicate apartments, Dan and I, and so does Patrick and Rodney. And so in our deals, we have passive investors. And from my understanding, there's ways that you can bring a 1031 into a syndication style, but it kind of requires a, what is it, Dan, a tenant in common?
Yeah, tick structure.
A tick structure. And so it's a little bit more complicated. And so I to my knowledge, it's not so common to do a 1031 for a passive investor into a syndication. Is that generally right?
That's correct. Yeah, I think a lot of people don't really know about it. They don't know the planning that needs to be involved if you're in sort of a partnership structure and you want to do a 1031 exchange, but you don't want to keep the whole partnership intact. So, what I like to tell people is the rule that the IRS has is that the same taxpayer that starts a 1031 exchange has to be the same taxpayer that finishes the 1031 exchange. So it has to look similar on both sides. And so whether you're using an EIN number or whether you're reporting taxes under your Social Security number in like a disregarded entity, those are the things that the IRS is going to look at. And so usually if somebody has a partnership and they say, we're just going to, this partnership was only intact for this particular piece of property. Once we sell this piece of property, it's going to go away and we're just going to create something else. Then the same taxpayer that's selling can't really buy the next piece of property. Or, a lot of times investors will say, I want out. Just give me my money. So in that particular case, you can't do a 1031 exchange. But, there's a lot of reasons why partnerships might split up and distribute assets out to the partners. And so if there is a legitimate business reason for the partnership to distribute the asset to the individual partners, you can recreate and reclassify that property as a tenant in common structure and ownership form. And so there's a couple of rules, there's a couple of legal implications that a tenant in common structure has that partnerships usually solve a lot of problems with. So, tenants in common have a right to partition, they have a right, all of them have to approve like a sale or a purchase. And so because of those things, if you have an honorary partner that you're working with and you put them into a tenant in common structure, it can get kind of ugly pretty quickly if you're trying to make one decision and go one certain direction and they're trying to hold you back or object to the decisions that are being made. But it is possible in a tenant in common structure you basically own a percentage of the whole piece of property. And so you can easily do a 1031 exchange if you're a tenant in common and you just sell your percentage of ownership. So if I had a 25% tenant in common interest, I could just sell my interest, take that money from 25% of the property and put it into my next real estate investment and do a 1031 exchange that way. So we've gotten a lot of calls, unfortunately, from limited partners that wanted to do a 1031 exchange, but they've called us too late. So they call us like the day that the property is selling on the closing. And they'll say, you know, I want to do a 1031 exchange. Well, how are you selling? Well, it's in a partnership. You know, the property is in a partnership. And I'll say it's too late. So all that conversion work has to be done before the sale actually closes. So there is some planning involved, and you know, it does get complicated. Like typically you have to put together a tenant in common agreement. And so it's like a partnership agreement or like an LLC agreement. Typically an attorney that's experienced in that will draft that document. So you're probably going to have to find a specialized attorney that understands how to draft a tenant in common document. There was a guidance from the IRS that was put out in 2002. And so it's been around for a really long time, but they were getting so many requests from investors to determine whether the property was held in a partnership or whether it was held in a tenant in common structure. And people wanted to make sure that before they sold the property, they were converting it to a proper tenant in common structure so that they would be allowed to do a 1031 exchange. And the IRS just got tired of all these requests that were coming in. And so they put out, you know, a rev proc that essentially said, look, you guys need to comply with these 15 points. We're not even going to look at your request unless you cover, you know, all these different bases. And so that guidance is out there. So any attorney that you go to that you're asking, hey, can we convert to a tenant in common structure in order to allow some of our partners to do a 1031 exchange into their own investment, they should be familiar with that guidance and that, you know, checklist of essentially 15 things.
So I'm curious, I don't need all 15, but do you have a couple examples of what is on that checklist? What types of things have to be ticked off?
The types of things that you want to address is like, is there going to be a property manager that's elected to collect the rents? You know, how are you going to essentially collect the rents and do the repairs? How is the mortgage held is one of the things on there. And so sometimes, you know, a tax attorney will advise, well, if you have a mortgage that's held by the partnership, you need to convert it and essentially get that mortgage rewritten so it lists the individual partners in order to be a proper conversion. So there's a lot of different things like that. I'm trying to think of some of the, I'd have to look at the actual rev proc, but attorneys that prepare tenant in common agreements should be able to pull up that list for you pretty quickly when you sit down and talk about it.
I've got a quick question that kind of relates to that as well. This might be an attorney question, I'm not sure, but I'll throw it out there and see. Like Anthony mentioned, we do syndications where we don't have just, you know, one or two partners. We'll have, you know, like Anthony and myself on the GP side, and then we'll have, you know, 10 or 15 or 20 passive investors on the LP side. Mm-hmm. Is a TIC structure for the purpose of doing a 1031 exchange an all or nothing thing, or is it possible to have maybe there's like one investor who's just adamant about being able to 1031 out? Is it possible to carve out a section of the deed for that one person and then leave the rest of the entity the same in its original structure? Or is it, if one guy wants to do a 1031, then all of a sudden we've got to split this like 15 different ways for 15 different people?
Yeah, that's a really good question. And I was taught in law school that the right answer to any question as an attorney is it depends. So, you know, as a qualified intermediary, that's what I do for the 1031 company. And so when I serve clients, I understand and I read a lot of things that attorneys advise on, but I'm not practicing as an attorney. And so I would say that that's a great question for your individual counsel.
I'll rephrase it then. Have you ever seen it done? Are you aware of it happening? Like, has anyone ever done it?
That's a great way to ask. We are familiar with several different, people that do exchanges on a common basis. Mm-hmm. And what they'll do is they'll set up different entities that are all tenants in common with each other. So say you have a partnership and maybe it wants to remain intact to some extent. So maybe you create some sort of an LLC around it. The LLC can hold title with another LLC as a tenant in common. So in that case, the law and the IRS treats entities a lot of times the same as like a person. And so that can be sort of confusing for people who are not familiar with the structures that they put in place, both around the legal definition of that and the tax definition of that. But yes, you could theoretically, have one entity holding 50% interest as a tenant in common with maybe two other tenants in common that each hold 25% of the property.
Okay, interesting.
Is this similar
we do have a question
from kind of thing that you were telling me about, that when we were talking about this all or nothing conversation that we had, and there was and you were mentioning about how you have basically a family office that has an LLC, and they enter into all of their deals that way. Is this similar to that?
Yeah. So there's some clients that we have that are, family office money. And so they have some different people that will invest into the deal, but each individual investor has a disregarded entity that they invest through. So, there might be 3 or 4 people investing in one property. So they have like 3 or 4 LLCs that all take title to the property as tenants in common with the other LLCs. And so that's how they can do, they hold the property that way the entire time. They don't do any conversion, but they set up their tenant in common agreement to be able to run the property properly. And they're so familiar with each other that they've been doing business for like the last 25 years together. So they're very comfortable with the business relationship. And so a lot of times if they sell a property, they'll just 1031 into the next property, and they might pair up with a different partner, or they might just take different percentages in the new investment. But that is something that we've seen, and it works pretty well for that type of structure.
Great. We do have a question here from Dan in the chat. He's asking, can you put some proceeds from a sale into construction of the new property, or does all the money have to go into the purchase?
That's a really great question. It kind of depends, but generally, so what you're asking about is considered like a construction exchange, something that you would maybe buy a piece of property and then develop, either build a building or make improvements to. And anytime that you do a construction as a part of a 1031 exchange, the thing to keep in mind is that the IRS says that construction services are not considered real property, and all of your proceeds have to be used to purchase real property. So when you think about the legal definition of real property, that's like land, an office building, anything that's like on a survey or appraiser's report. When you're doing construction, it gets a little bit difficult because you might get a bill for lumber or drywall, and those things aren't real property. And so you have to have a specific person that's like a third party outsource that's holding title to the property, while any improvements are being made. And you can only use a 1031 exchange fund to purchase the property after it's already been improved. And so you essentially can do a construction exchange, but you have to set it up very specially. So a lot of times the CPA is involved in that, making sure that all of the money that's in the 1031 exchange is going towards a line item that's actually improved property. And so you'll have to find other ways to pay, the contractors and for the materials up front. And then you can use the value in the exchange to pay for the finished product after it's done. And during that time, that's where a qualified intermediary comes in handy, because a lot of times we'll serve as that title holder that's on record while the construction's going on. And then when you're done with the construction or at the end of the exchange, whichever comes first, the title gets transferred back to the 1031 exchanger.
So
is there a time period on that? Sorry, Dan.
What's that?
I was curious if there was
a
a time limit on that between when you're going on the title and the length of the exchange. Is that the 90-day period that this all has to kind of occur within?
In the 1031 statute, there's two deadlines that are hard deadlines. The first one is that you have to identify your replacement property within 45 days of the first closing. And then the second one is that you must acquire your replacement property within 180 days of the first closing. So the time clock starts ticking when you sell your property. And then the 45 and 180 day deadline run in tandem together with each other. But essentially the IRS has said 180 days still applies to a construction exchange. There are some attorneys that will structure a construction exchange outside of that safe harbor. So the 180 days, the IRS has said, this is a safe harbor. If you stay within this time limit, you won't get in trouble. But they've also left open kind of a window to say, well, you can theoretically still do an exchange that's longer than this 180 days, but it's not in the safe harbor. And so you have to really make sure that it's an actual exchange. So a lot of times a specialized tax attorney will get involved with it's familiar with those types of deals.
Would this theoretical construction scenario be a good opportunity for a reverse exchange where you kind of like start the project and then when it's getting close to being done, then you know, I don't think you've explained what reverse exchange is yet to the listeners, but would
You're jumping ahead, Dan. You're jumping ahead.
Am I stealing the fire for later?
Hey, real quick before we the reverse exchange is a really cool thing to talk through, but real quick, Dan had a follow-up question in the chat, which was just, are those dates, are they extended right now because of COVID? And then how long do you think, if they are extended, how long they'll be extended?
Yeah, so the IRS has officially extended those the 45-day and 180-day deadlines. So they've said if you had one of those deadlines, either the 45-day or the 180-day deadline, fall between April 1st and July 15th, then we're going to extend that date to July 15th. And so it's kind of interesting, you know, as an attorney, I like to get into the reasons why people make exceptions to a rule. And normally when you see like a disaster, like a hurricane, some sort of natural disaster happen, the 1031 exchange deadlines will get extended, but they'll just tack on 120 days to whatever their date was. And so in this case, they don't have a tacking mechanism. They've just said, you know what, we'll push this off until July 15th, and then you'll just have to turn in whatever's due on July 15th.
Do you think there's a chance they'll extend that deadline come July 15th?
In the 1031 space, there's a lot of people saying that they think they will be extended. Personally, I don't think that they'll be extended. I think that the IRS I actually don't think that the guidance that they put out was specifically directed at 1031 exchanges. It just happened to affect 1031 exchanges. And so I think that they're sort of like dealing with more important things that the IRS needs to deal with right now. And they're not so worried about people saving on capital gains.
That makes sense.
So I guess, we'll see. We try and keep updated on LinkedIn. And so, watch our feed on LinkedIn to see if there's any updates. We'll post them right away if they come up. But essentially, I wouldn't hold my breath for that.
Gotcha. All right, Dan, sorry to hijack you. Now you can take over with the reverse exchange, which is pretty cool.
Yeah. I know a little bit about reverse exchanges, but not much. So I was just wondering if this construction scenario that Daniel threw out, if that would be a candidate for a reverse exchange, if, by the time that money actually gets transferred, all that lumber and drywall has actually turned into a real asset.
Yeah, absolutely. Reverse exchanges are great things to pair with construction exchanges. So technically you can do a construction exchange as a forward exchange or as a reverse exchange. So for those of you that don't know what a reverse exchange is, in a regular 1031 exchange, the forward exchange, what happens is that like a qualified intermediary like me actually gets assigned the sales contract by the seller at closing. And so we step in and we receive the benefit of that contract. So the benefit when you're selling a property is the money, right? And so we'll escrow that money and we'll hold it on behalf of the exchanger until they find their replacement property. And then the same thing happens when they go to purchase their replacement property. That contract gets assigned to us. We step in and we pay for their part of performance on the contract. And so that's what a regular forward exchange looks like. A reverse exchange is done in opposite order. So instead of selling first, they buy first. So if the purchaser's contract gets assigned to me and I step into their shoes at closing, the benefit that I receive is the deed. And so then we'll escrow the deed and hold that until they're ready to sell their relinquished property. And so this 45 and 180 day time period still applies. They have 45 days to identify which property that they own that they're going to sell. And then they have 180 days to actually close on that sale. So that's how a reverse exchange works, as opposed to a forward exchange, is that we just become a title holder to the deed instead of the escrow holder for the money. And it's great. So we've seen the last couple of years, especially in this market, it's been very difficult for investors to hunt a good deal. And so we've seen a lot of real estate investors that say, gosh, there's so many properties out there, but they're all priced so high that we don't think we can make as much money as we need to on these deals. And so they're leery to sell their property and get into a 1031 exchange because that 45 days is so harsh for them to absolutely need to find something within those 45 days. And so some of the sophisticated investors have said, you know what, I have good credit, I can get a loan from my bank to cover another building or another investment. And so I'm just going to keep my eye out on the market. And when a good deal comes up, I'm going to enter into a contract for it. I'm going to do a reverse 1031 exchange. And then I'm going to identify one of my buildings that I have, or maybe, I can identify several of my buildings, put them up for sale, and then make sure that I sell one of them within the 180-day time period. And so it takes that, the pressure to find that good deal, takes that pressure off and allows them essentially as much time as they need to find the good deal. And then they can still do a 1031 exchange to switch out their assets but still get the tax benefits from it. So we've
Very
seen, when I started in this business, I was doing probably about 90% forward exchanges and 10% reverse exchanges. And last year in 2019, probably about 60% of the exchanges that I saw were reverse exchanges.
So it's probably
So,
directly correlated to how hot the market is, right?
yeah, absolutely. And so as the market changes, your 1031 exchange strategy may change in order to make sure that you're sort of leveraging the best part of the market that you can.
Mm-hmm.
Mm-hmm.
Hey, Cori, are there any asset classes that do not qualify for 1031 exchange? Real estate
That's a
assets?
great question. Real estate assets all qualify as long as they're considered real property. So in the code, you can actually go look up the code. It says stocks and bonds do not count. Partnership interests do not count. And so that excludes REITs or like a percentage of a partnership interest. So if you buy or sell anything that looks like a piece of paper, you're not allowed to exchange on that. But, there's a lot of different real estate. So a lot of times the questions that I get is, well, I live out in West Texas and I have a horse ranch that's an operating working business. I've bought it, 35 years ago, it was worth like $5 and now it's worth $5 million. I have all this capital gains. Can I invest in something else that's like an office building or, raw land somewhere else? And the answer is absolutely.
It can't be a
as long
residence
as
though, right? Like you can't just buy
considered
yourself
real
a
property.
vacation home to.
Ooh. It depends.
Okay. So people could probably be sneaky, but I'm guessing technically you're not supposed to buy yourself.
Do you
a
have to
house
rent
and
it out
live in
a particular period of time or something?
Yeah, so a rental house, so this brings us to our third absolute mandatory rule for 1031 exchanges. We went over the two deadlines, the 45-day and the 180-day deadline. But the property does absolutely have to be used for investment purposes or for a trade or business. So if you have a construction company and you have a bunch of tools at the shop, that shop is property that's used in operating a business. If you are a real estate investor and you have a piece of raw land and you bought that piece of raw land just to see it appreciate in value, that's considered an investment. But your home, your residence is not considered investment property. It's considered personal, your personal residence, your homestead. And so
But you
that
could
is
probably
not covered
buy it in an
investment
LLC
exchange.
and then lease it to yourself, right? If you want to be sneaky about it.
Yeah, if you could. So there's a lot of, and so this kind of becomes like a tax gymnastics exercise, because usually the government will give you tax breaks on your residence that are even better than the breaks that they give for 1031 exchanges. So if you do want to sell your house and you're looking at, maybe you bought it a long time ago for $100,000, it's appreciated to $500,000, you're going to sell it. You have $400,000 that is subject to capital gains. There's another section in the tax code. It's called Section 121. This is what all the tax attorneys and I talk about when we go to conferences. But it essentially says that you have $250,000 for an individual that's completely tax-free. And so $250,000 is exempt from any capital gains tax if you sell your residence.
Is it
And if you're
500 for? Oh, sorry, you're gonna just say that
For joint.
Yeah, so if you're single, it's 250, and if you're filing as a married couple, then it's 500,000. So, if you had $400,000 in gain and you were married and doing that sale, that gain would all be essentially non-taxable.
And you can do that. Is it every 5 years, or how often can you do
Oh,
that?
I'm not sure what the limit on that is.
Because I know you can't
That
just
would be a
like
great question.
do it multiple times back. I feel like there's a number of years where you have to live there before you can.
I believe it's 2 years out of a 5-year
two?
window, right? Or
Oh.
3. I think it's 2.
Okay. Because I know
But
you
I might
can't
be
just
wrong.
buy a house, live in it for 6 months, then keep trading up and doing it super
Yeah,
fast like
I
that.
believe you have to live in there for a 2-year period. It doesn't have to be consecutively within a 5-year window. I
Well,
think.
no, I
This is a
think
great
that. Oh, what were you going to say?
I was going to say, this is a great reason to take your CPA or accountant out to lunch and ask them these types of questions. They love
Yeah.
this stuff.
I think they're busy right now. I feel like
Yeah, they're
my
swamped.
CPA is swamped.
Hey, Daniel had a follow-up question here, which was, would buying minerals fall under real property?
Generally, minerals do count as real property. Yeah, so there are
They
a
said
couple
mineral
of different classes.
rights.
Mineral rights, yes, do count. Royalty interests generally count. There's a couple that don't count, but they're very specific case-by-case basis. And so in general, most mineral rights do count. We've had exchangers that have sold mineral rights for sand, mineral rights for oil, all sorts of interesting things. And I had mentioned too, going back to, shares don't count. So if you wanted to purchase REIT shares, that does not count as like kind property. However, there is such a thing called a Delaware statutory trust that a lot of wealth advisors will set up to kind of look like a REIT structure, but you can buy into a Delaware statutory trust. So it's a great way for people who are maybe retiring that don't want to be an active investor or have investments that they need to do anything with, to kind of be a passive investor and just collect a check.
Yeah, for
so
those
we don't
people
have a-
watching this that are active investors looking to buy properties and they're having issues getting sellers to sell because they don't want to jump back into real estate or they're over real estate, but they don't want to pay taxes either. I use that strategy on my second property. Told the seller, like, he wanted to be done with being a landlord, but didn't want to pay the tax. And I was like, all right, you can 1031 into a DST. And he's like, what the heck is that? And most people don't know what they are. So I think that's a really useful strategy for people trying to find deals right now, because I'd say 90% of the people out there don't know what a DST is. And it's a really great way to get potential sellers all of a sudden interested in selling if they are just kind of burnt out and don't want to do it anymore. So very powerful.
There's a couple of downsides with the DST, though, in terms of how
Well, I
long
mean,
you have
it's
to
like
sit
a
in it.
REIT. So, I mean, we all
Right.
know REITs kind of suck. So it's not like ideal if you're like doing what we do, but for a lot of people, it's better than paying the tax. And at least they theoretically should still get some kind of return. But yeah, that I'm not, I would never personally invest in one unless I was just really old and didn't want to do anything, but
You're getting there.
a couple years.
One thing that I
We've
did
had-
want
we've
to
had-
mention is that there are two different DSTs. You have the Delaware Statutory Trust, and you have a delayed sales trust is the other one. And I did talk to Cori about that, the differences between when somebody would want to go 1031 versus just delayed sales trust or deferred sales trust, I think is the right terminology for it. But there are situations where maybe a 1031 wouldn't work and a deferred sales trust would, where it's kind of the same thing. Qualified intermediary that does DSTs would step in and maintain the money in escrow if you're selling, or the property in escrow. And but that's really kind of outside this conversation, but because I don't know if you want to comment on that at all, Cori, but that is a good instrument to use in the right situation.
Yeah, and I think it's worth having a conversation. If you're looking at different strategies, it's always nice to investigate that. A lot of the tax attorneys that I've talked to are not big fans of the deferred sales trust, but I'm not really that up to speed on exactly how they function and exactly why they would not be fans of that. But I think it's worth having a conversation with your advisors just to kind of see, what the options are out there. We always tell our clients, look, the more information that you get up front, you can make better decisions as you go along the way. And a lot of times, even when I'm talking to attorneys, they don't realize that if you're thinking about selling a property or your client's thinking about selling a property, come talk to me and have a conversation 2 months in advance of when you're going to sell, and I can have a lot more options for you. If you come to me a week before you sell, your options have narrowed significantly in that amount of time. And so I think it's always good to, investigate those things if you're thinking about switching up your investment.
So
I'm
I think you
unfamiliar
probably
with
answered this on this last go around, and I was listening. So what is the time frame that someone should keep in mind if they are thinking about doing 1031 and they need to come to you to start planning for that?
That's a great question. So when you think about putting your property on the market or talking to brokers about selling your property, then that's a great time to come and talk to me. And usually it's like a 15 to 20 minute phone call. And so I'll make sure and ask questions about, these are the things that you should think about and ask yourself to see if you want to do a 1031 exchange or not. And then the absolute last minute that you can call me is right before you sign the closing papers. So that's kind of the range of when people should call me. So anywhere from a month before you sell the property to a week before you sell the property is the optimum time to come. And obviously, if you have a lot more complicated facts, if you're dealing with partners, if you're dealing with investments that you think might not be real estate, or you're not really sure, then talk to us sooner rather than later.
Yeah, not after the fact. I was talking to a local qualified intermediary up here, and he said it's not uncommon at all for people to call him after the closing with a check in their hand saying, hey, I want a 1031 into my next property. And he's got to say, that sucks. You screwed that up. You can't touch the money. It's almost like your 401k. If you touch the money, you get the taxes, you get the fees, you get hit. So it's extremely important that no one touches the money if they want to do a 1031. So,
and I think to that point, I always try and make it very clear that if you're at the closing table and you're thinking about signing the papers to sell your property and you want to do a 1031 exchange, do not sign the papers. Walk away from the closing table first, get the 1031 exchange set up, and then you can come back to the closing table and sign. I can't tell you how many attorneys that I've had that have actually called me that are real estate attorneys, and I feel like they should know this. And they'll call me the day after their client closes on a property. And they'll say, okay, if they want to do a 1031 exchange, don't worry, the escrow agent still has the money. They haven't touched the money yet. And I'm like, no. The rule that the IRS has is that the taxpayer cannot have constructive receipt over the funds. And so what that means is if it's sitting with the escrow agent, even if they don't have the check in hand, even if it's not in their bank account yet, they still have, violated that constructive receipt rule. And so that's why the key to doing a successful 1031 exchange is you have to have that sales contract assigned to a qualified intermediary before the sale happens. And so that's really what the entire basis turns on.
Okay, so not money in hand, but signature on paper. That's the catalyst. Very interesting.
So Cori, if I'm sitting at the closing table and I decide at the last second, I want to do a 1031, and I step out into the hall, how long does it take to set that up? Is that something I can do pretending like I've gone to the bathroom? Or am I gonna have to be like, hey guys, I just remembered I left the stove on, so I'll be back?
That's a great question. it takes us about 15 minutes to do the paperwork and make sure that everything's set up properly and send that to you. Usually what we do is we'll involve the escrow agent that's closing the transaction in that as well, because they're going to have on their record that the transaction was signed over to a qualified intermediary. And so we'll have to do some communication. So don't pretend like you just left the stove on and you have to go make a call.
Just disappear.
But you'll want to tell the escrow agent that's closing the deal, hey, hang on just a sec. I think I want to do a 1031 exchange. Let me go set up the 1031 exchange first. And so we've been in that situation, a handful of times, and we're able to put the paperwork together and get all the ducks in a row while the person was still physically in the office waiting for the closing. And then we get all the documents executed and they're able to close without too much delay.
And are there any significant downsides to just deciding I'm going to try and execute a 1031, but it doesn't really go through? Are there significant fees or anything associated with that a person would say, like, maybe I don't want to just frivolously attempt this?
Mm-hmm. Yeah, that's a great question. So there's two downsides to attempting a 1031 and not having it go through, besides, having to pay taxes if it fails. So the first is the fee. So an exchange company charges usually in the range of like $800 to $2,000 for an exchange, for a regular forward exchange. So, depending on how much sales or how many capital gains tax you're actually deferring in that sale, you might want to do the math first before you enter into exchange. I've had exchangers that when we sit down and do the math, my fee is more than what they would save just paying the tax bill. And so I'll say, it doesn't make sense doing it for your transaction. The second downside is that it will lock your money up for a period of time. So once your funds go into that 1031 exchange account, I can't release them. The IRS says that they have to stay with me until the exchange fails. And so the first point that an exchange can fail is if you don't identify any property that you're going to purchase in that 45-day period. So if it gets to day 46 and you haven't identified any property, then I will send your funds back to you and they'll be in your bank account instead of my bank account. But so it'll lock it up for at least 45 days. If you pass the 45-day period and you have identified properties, think of that identification as being like the 10 commandments. Okay, it's written in stone. You can't change it. It's forever like a monument to what you're going to do next. So say you identify 3 properties and maybe you close on 1 property, but you've only used half of your exchange funds. And then you say, you know what, I can't find any other good deals. The properties that I've identified, they're not going to work out. They didn't pass the due diligence period. I want my money back. Well, that money is locked up until the 180 days are over. And so that's a really important thing to keep in mind, because you might want to use that capital on another deal that comes across. And so it does lock up those funds. And so we try and really have a lot of communication with our clients to make sure that they understand, look, just because you think that this is not going to work doesn't necessarily mean that we can release funds right away for you. So it's really important to let your qualified intermediary know what your plans are, how the search for property is coming along, and if you think that you might not be able to complete the exchange, because they can kind of help you get out of it as well as help you get into it.
That's super interesting. I didn't realize that you and I'm like myself, if I was doing the 1031, couldn't just terminate early to exit it and say, never mind, I changed my mind. In that example with the 3 properties, and maybe you don't use the entire amount for a property, can you just be taxed on the portion that you didn't use then and just roll that 1031 portion for the cheaper property? Or do you have to use it all?
Absolutely. You don't have to use it all. in order to defer all of your taxes, you do have to use all of that value. And so in the industry, we call this the napkin test. People talk about it a lot. And essentially, it's that you have to trade what you had before and into something new that's equal or greater value. And that means both in the debt and the equity that you have on the property. So say you sell a property for $1 million, you have a $400,000 note on it and $600,000 in gain. You have to put all of that $1 million into the next property, and you have to replace the $400,000 note, and then the $600,000 cash that was in your exchange account has to go towards that property. If you reduce the debt and only take out, a $200,000 note, then you have to pay tax on the difference of that debt. And if you don't, say you only used $500,000 for replacement property, then you would have to pay tax on that $500,000 that you didn't use in the new property. So a lot of times I'll tell people the tax that you pay, think of that as like the cream rising to the top. The IRS is always going to try and take the highest tax rate out that they can. So when you're paying tax, if you don't use all of your money in an exchange, the highest tax rate they're going to take out first until they get to a lower tax rate. And then the other thing to keep in mind is that the basis that you put into the property, so your original investment, in a 1031 exchange, that always moves over into your new property first. So if you put, $400,000 down and that was your basis in a property, it's now worth $1 million. And instead of doing a full exchange, you only purchase your new property in the exchange for $500,000. They're going to move $400,000 of your basis over into the new property, and then you're going to save taxes on $100,000, and then the rest is going to be taxed at the highest tax rate that they can get out of you.
One thing we haven't talked about, Cori, is the depreciation from one property to the other. Can you explain how that changes when you use a 1031?
Yeah, so depreciation when you use a 1031 is calculated into the amount that's deferred, but there's some amount of depreciation recapture. So if you're not using all of your exchange funds, the depreciation recapture tax rate is usually more like an income tax rate. And so it's going to be a higher percentage than the capital gains tax rate. So capital gains, depending on what income bracket you're in. So I don't know if, it's a really good exercise just to Google what capital gains bracket you're in, but it can either be 0% capital gains, 15% capital gains, or 20% capital gains. So most of the time people assume that they're in the 20% bracket, but we always tell people, double check with your accountant or your CPA before you do a 1031 exchange to see which bracket you're in. But essentially, and that goes for short-term capital gains as well, is usually a much higher rate than long-term capital gains. So if you've had a property for a year and you want to do a 1031 exchange on it, you can, but just keep in mind that whatever gain you had that you're deferring is going to be a short-term capital gains rate. So if you go to take any money out of the exchange, that's going to be the first amount right off the top that they're going to take, in taxes.
So the basis of my question I buy a property, I do a cost segregation on it, and I depreciate as much as I can on that property. And then 5 years goes by and I'm going to 1031 into a new property. There is a limit as to what I can depreciate on the second property because of what I depreciated on the first property, correct?
That's a great question, and I am not qualified to answer that one. You're going to have to talk to your CPA about that. I know that a lot of times what happens, so when you do something on your previous property, they'll essentially just mirror it on the new property. And so a lot of times the discussion that I hear going back and forth is like, well, we had to, take this much depreciation recapture on these refrigerators or washing machines or whatever they might be. However, we just rolled that over and we're going to take X amount of depreciation on these ones as well. And so it balances out. So, but that's a great thing that your CPA should be able to work through with you.
Awesome. So do you guys have any more questions? I notice we don't have any in the chat
I do not.
area.
No, that hit all my questions. If anybody in the chat has any final questions that you'd like to get answered before we let Cori go, now is the time to throw them in there.
Cori, do you want to tell us how we can get in touch with you?
Yeah, absolutely. The best way to get in touch with me is just to give me a call, and I'll make sure that you guys have my cell phone to distribute out, but just in case, it's 425-766-7107.
And do you have a website as well?
Yeah, we gpx1031.com.
I've got a question. For those of us who are on the geekier side and enjoy reading about this kind of stuff, do you guys have any materials on your website, or do you have any books or resources that you'd recommend for people who want to ramp up their 1031 knowledge?
Yeah, normally I would say yes. I think that the 1031 space can get pretty complicated. And so a lot of times the clients that I work with that want to know more, I'll tell them, look, just find really, really good advisors that do this a lot. Mm-hmm. And then just tell them what you want to do. Like, tell them your ideal structure of how you want the transaction to go. And then just have them deal with your specific instances. Usually that works a lot better as a business strategy for investors than trying to read about and putting time into the different 1031 rules. The rules are kind of wonky, and what I've found is that there's a lot of really bad information on the internet. So even like I've seen CPA blogs that I know for a fact doesn't line up with what the code says. And so it's like a CPA that's like trying to attract these customers, but they don't really know what the rules are. And so I would say, don't necessarily Google stuff. Find somebody who's a great tax attorney or a really good qualified intermediary or a CPA that has other 1031 exchanger clients that can be trusted, and ask them about particular situations. Okay. The other thing that I see that's very common in this industry is that some professionals have like 0% tolerance for any risk at all. And then other professionals have like a really high tolerance for risk in this area. So the one thing that you want to think about in this area and learning about it that I try and stress, especially to attorneys, is that, look, the IRS makes these rules and it's been around for a long time. But if your client gets in trouble with the IRS and gets audited, you want to be able to answer all the questions for the IRS agent. Most of the time, the people who have gotten audited for 1031 exchanges, the auditor that's auditing their file doesn't even understand what a 1031 exchange is and how it functions. And so that's why you almost have to have a team that can put the paperwork trail together for you to educate the IRS agent along the way to make sure and say, like, see, we did this correctly. All the paperwork lines up. Here's why it's correct. And so, I think that it's better to have people that either kind of in the middle of the road on the risk calculus, or if they're like super risk adverse or like super risk tolerant, that you kind of ask them, where do you fall on that risk scale? Because that's really important.
That's a good point. I've seen that with CPAs as well, where they're so risk adverse that they don't want to take the chance of, taking advantage of certain deductions that certain people might be able to get. They think that it's a risk for them to do that. Even though they're perfectly legitimate deductions, they think it increases the chance of an audit. It's like, that's almost kind of like lazy, in my opinion. Like, it's there, you could do it, but you just don't want to take the chance of having to do a little bit of extra paperwork or send a letter to the IRS or something just to back up what you did. So.
Yeah, absolutely. And I think too, sometimes they're scared of the professional rules have gotten a lot stricter for CPAs. And so they're personally responsible for a lot more than they used to be. And so I think sometimes they think, there's so much for me to learn in that area, or like I have to jump through 10 different hoops in order to get to the right answer.
Yeah.
And so like, it's just too much work. Like, I don't want to take that type of risk just for this one client. And so that's where it's really important to have a good relationship.
Yeah.
Yeah, and this is something that Dan and I talk a lot about, is finding specialists who work specifically in this area, that's real estate or 1031 exchanges, and that the two positions that you need to have on your team that you absolutely do not want to skimp on is a good attorney and a good CPA, somebody who really understands this.
Yeah, you can't keep going to H&R Block and expect to have things.
Wait, what?
Oh, sorry, is that? If you got more than just a W-2 to file, it's definitely worth paying a CPA who knows what's going on, especially in real estate, because there's a lot of really good CPAs that don't understand real estate. And actually, this just happened to my brother-in-law. He brought his tax docs in for his first year where he was invested in one of our deals, and the guy who he brought it to just didn't know what he's looking at. And so I'm like, all right, you got to go to my guy. He knows his stuff. So it's worth spending a couple $100 for to have it get done right, and saves you thousands for sure.
Yeah, a good CPA, good lawyer is going to save you more than they cost.
And a good qualified intermediary.
And a good
Absolutely.
QI.
And I tell that to clients too. We have attorneys that clients have worked with that bill at $500 an hour. And I'll say to a client, you really need to have a specialist. Here's a couple of names, please feel free to hire your own attorney. And they'll say, oh, the attorney that you sent me to, they're just too expensive. They're $500 an hour. And so I went to somebody who's only $200 an hour, but then their bill ends up being so much higher because the poor attorney had to, do all this research and learn an area of law that they weren't really qualified in. And so they spent 10,000 hours trying to learn this area of law that somebody was charging $500 an hour for, because they, can get the entire transaction done in just a couple of hours.
This is the classic example of you don't hire the plumber because he can snake the drain or fix the leak. You hire the plumber because he knows where to find the leak.
Yeah, absolutely. Absolutely. And that's where, you guys being in real estate create a really valuable network to know the people that you work with and have good relationships with.
It is a relationship biz, that's for sure. So
definitely. Hey, this has been fantastic. We've gone a little bit over the hour mark here, but Cori, I really appreciate your time. It looks like there are no more questions in the chat. I think we have answered every question conceivable under the sun. Everybody is now a 1031 experts. So
Perfect. My job is
been in your time.
Yeah, absolutely.
Thanks, Cori.
Yeah, thank you so much, guys. We really appreciate it.
yeah,
Thanks,
thank
Cori.
you.
Take care.
Take care.
Bye.